and welcome to the EMU Lab lecture by the Governor of the Bank of France, Villeroy de Galhau. And I want to tell you how exciting this is for me in particular. Of all the people who've come to speak at this institution, I think I've read Governor Villeroy's speeches more often than anyone else. I've actually followed it very closely alongside the speeches of the other central bank governors in the Economic and Monetary Union, working in the Governing Council of the European Central Bank. And so I know that this speech will be widely read and viewed. And that is perfectly in keeping with the mission of the European University Institute as an institute for higher education, and with our EMU Lab as an experiment in bringing policymakers into the academy in order to exchange views with academics like yourselves. It is a distinct privilege and a great honor to have the Governor of the Bank of France here. And I will allow our colleague Marco Butti to do the formal introduction, but I hope you will join me in welcoming them both to this very important lecture. Thank you so much for being here.
Thank you very much. Thanks to Francois for being here. Okay, it's the time of the year where students are departing, so on est en famille. Now, Eric mentioned the EMU Lab. This is the last, say, important meeting that we have for this first part of the year. So maybe let me just recall what we have done very rapidly. We have organized many workshops, seminars, lectures. I just recall Philippe Aguillon, who gave the annual lecture back in March. Then we had Philip Lane who came in May talking about inflation. So I think there will be some connections with what we discussed today. We had just 2 weeks ago Odile Renaud-Basso who also workshops. We had an important 2-day workshops back in May in preparation of what we have called the Florence Report, on what we are working right now. I just recall the provisional title of the report is Reconfiguring Europe in a Fractured Global Economy, and the subtitle Tackling Fragmentation and Expanding Policy Space, which is especially when talking about fracturing fragmentation, it seems to be an understatement, seeing what we observe right now. So today's intervention, today's lecture by François Villeroy de Galhau is, I think, very important for us in building our intellectual underpinning for the report. François has been governor of the Bank of France actually for almost 10 years right now. So it's probably the doyen within the governing council of the ECB. And François, also for those who follow the debate, he's, let's say, not shy in expressing his opinions on matters not only on monetary policy, but also on broader, broader issues. We have seen, just Google it up this morning, statements like, US no longer the land of freedom, but the opportunity for Europe. In this, EU should transform its strength into sovereignty, which is also, important concept. And today we focus on monetary policy. So I'm very curious because agility is not something that is usually associated to, or at least in terminological terms, to monetary policy. So it would be we are very curious to see what François will tell us. I mean, we have known each other for many, many years. So I think we met first when I was a rather young fonctionnaire at the Commission.
So was I. But it was long ago.
That was the prehistory. back, I think, beginning of the 1990s when you were a financial attaché, at the Pen Brep in Brussels for France. So we go back for a very long time, and I'm also very grateful to the bank, to François and the Bank of France for generously sponsoring the Tommaso Padoa-Schioppa Chair, which is and having been a big supporter of also the EMU Lab. Actually, we are going to have in the report that we are on which we are working. There will be contribution also from officials of Banque de France. So this being said, okay, welcome everybody here and those online, and give the floor to François.
So, grazie, caro Marco. Ladies and gentlemen, dear friends, let me first say how delighted I am to be in the European Institute, qui a Firenze or a Fiesole. I heard many times about the Institute, but to be here is a different thing. It's my first visit. It's not only an impressive location with the view, all the trees, etc. It's also a summit of economic and European teaching, research, and I really appreciate it. Grazie, Marco. Thank you to Eric also for his very kind words. So, if an observer were to look only at the current macroeconomic data, in particular the convergence of headline inflation to our target of 2%, it might occur to this observer that economic stability has been achieved. But on closer inspection, it is certainly not guaranteed for the future. This is a paradox I will explore with you today, and I will use, if it works. Okay. This is a very simple chart that combines two dimensions, time and the scope of economic policies. I will come back to the left-hand column about monetary policy, but I want to stress the obvious about the right column. The other economic policy levers, be it fiscal or structural, are not working well today. This is because we have overused the fiscal instrument through past crises, COVID, inflation, etc. And asymmetrically, we are correcting this fiscal instrument too slowly today. It's true from the US to my own country. And conversely, we have not sufficiently promoted structural reforms for growth and productivity. The other obvious point about the bottom right box is that unpredictability is peaking for the future, notably due to the policy shift by the US administration. But Europe knows how it should respond to seize the moment, thanks to the Letta and Draghi reports, and I am especially pleased to commend them here in Italy. A quarter of a century after our monetary sovereignty, and we were modest architects, caro Marco, of this monetary sovereignty, we must now ensure our economic and financial sovereignty. But so far, and sorry to say that, Europe's reaction is still too slow and too weak. I call for a mobilizing deadline, as Jacques Delors did with January 1st, 1993 for the single market and January 1st, 1999 for the single currency. For example, 1st of January 28. As the saying goes, the difference between a dream and a goal and a project is a deadline. Posso dirlo in italiano? La differenza tra un sogno e un progetto è una data di scadenza. And we need this. Monetary policy cannot do everything. and the euro area must not resign itself to being trapped in a state of controlled inflation, but sluggish growth. This is about the right column, but today I will focus on the two boxes on the left and delved into two conundrums: why the current monetary situation is credible but not static, and about the future, why the monetary policy must therefore be agile while remaining predictable. This will be my second point. Let me start with the present situation. It's satisfying. Inflation has been successfully brought back to target. We are now in a good position in the euro area, with inflation at 1.9% in May and forecast at 2.0% for this year on average. Hence, our Governing Council, around President Christine Lagarde, decided to cut the deposit facility rate to 2% at our last meeting 2 weeks ago. Our latest projections show that we shouldn't fear in Europe, contrary to the US, an inflationary effect of tariffs. This 2 and 2% inflation, 2% interest rate scenario of inflation close to target and policy close to neutral rate feels like back to normality after nearly a contrasted decade. This decade was sequenced first with below target inflation till COVID, followed by an opposite phase with the largest inflationary shock in decades and an inverted yield curve. And you can see it on this slide. So back to normal is a very positive step. Nevertheless, we still live in abnormal times, and back to normal does not necessarily mean an end to the journey. This return to 2% inflation is also highly satisfying, as it was much less costly in terms of output and employment than feared. I remember the fears there were in 22. The unemployment rate is at its lowest level since the launch of the euro, at 6%. And Banque de France research suggests that had inflation expectations been as poorly anchored as they were in the 70s in the US, this is the right-hand panel, our policy rates would have had to peak around 8% instead of 4%. But this increased central bank credibility, which was very useful, does not come out of the blue. Let me stress that when politicians undermine central bank independence, they put in peril this credibility that allows central banks to stabilize inflation at a lower cost, as we could see in the most recent episode. The present situation is satisfying, but it's not static. This return to 2 and 2 should not give way to complacency and passivity. China's mercantilism and the current US administration tariff policy have severely undermined the rules-based international trading system. And here you see some measures of global uncertainty. Can I stress that in addition, global bond markets, and look at the yellow curve, seem increasingly worried by public debt sustainability in the US and across the world, and we already see signs of tensions at the very long end of yield curves with the risk of international spillovers. Furthermore, and I look at the present situation, we could see once again since last Thursday, oil price strongly reacts to dramatic geopolitical events. It's now back more or less to its pre-Liberation Day level. It's still far below the 22 level after the Russian invasion of Ukraine. We will monitor closely the possible spillovers of energy prices. Let me say it very clearly. If ever these consequences happen to be lasting and propagating, i.e., affecting underlying inflation and inflation expectations, we could possibly adapt our monetary policy. To put it short, no automatic monetary reaction, but monetary agility, on which I will elaborate further. This is about the oil price. Let me add that over the longer term, other supply shocks are likely to occur more frequently, and we are all aware of that. Extreme climate events are likely to disrupt supply chains. Information technologies are developing at a fast pace with artificial intelligence and quantum computing that will possibly increase productivity. More frequent supply shocks, and this is another important message, more frequent supply shocks will not mean per se higher inflation, contrary to what is often mentioned or alleged. But they will very probably mean a more volatile inflation, which could weaken the anchoring of inflation expectations. The current equilibrium is unstable. As we have now entered a territory close to the neutral stance, the natural rate, R star, becomes a less meaningful guidepost. The debate at present is no longer about navigating by the stars to wonder whether we are restrictive or accommodative. It is about how to temper this volatility I stressed in a world of uncertainty. Here, agility, key word of the day and of the future, and laying out a clear reaction function play a crucial role. And this brings me to my second point: how can monetary policy be at once agile and predictable? Because let me say it this way, fair enough about agility. Nobody would recommend rigidity. But let me acknowledge that agility raises two serious questions. A, agility does not mean that we should rush to come back to the 2% target at short notice in case of inflation volatility. We have a medium-term orientation around our symmetric objective. This implies we do not have to respond to deviations from target at one point in time. Instead, we have to react to dynamics that risk pushing inflation off target. What matters is whether a deviation from target is more likely to increase or to decrease. And medium term means within our projection horizon. And B, second question, agility should not imply that we are unpredictable or indecisive. Let me insist a bit on this question, because in the past, we had strong forward guidance, and our actions were described by some at that time as being on autopilot. I think it was exaggerated, but you heard about that. Today, we are sometimes accused of the opposite, flying blind or making ad hoc decisions. I do not believe that we are doomed to wander between these two extremes, autopilot or completely ad hoc decisions. It is time, and I will elaborate a bit on that, to return to a concept that had been less used in recent years, the central bank reaction function. In other words, we need to clearly state not what we will do, but how we think and will act in a readable way. I would say in French, lisible, perhaps in Italian too. Readable is more for a text, but let me speak of readability of also our monetary policy. So, what is our Eurosystem's reaction function? Since 23, it has been based on 3 criteria: the inflation outlook, trends in underlying inflation, and the transmission mechanism. When inflation was surging and monetary policy was tightening rapidly, it was natural that the second and third criteria were emphasized. Underlying inflation, because with high uncertainty about the inflation outlook, it was important to ensure that inflation expectations did not become de-anchored, and the underlying inflation was this backstop criteria. Likewise, about the third criteria, transmission, it was important to assess how quickly changes in policy rate were transmitting to the demand and supply of credit. Indeed, one word about the transmission lags which we could observe in the most recent years. They have been at least as swift and satisfactory as in previous cycles. Each rise in the deposit facility rate, our DFR, was almost fully transmitted, this is what econometrics show, was almost fully transmitted to bank loans, be it to businesses and households, within 1 year. And loan volumes in the euro area weakened sharply with a peak response 18 months after a rate hike. However, so these are satisfying results about transmission. However, we must remain vigilant today to the broader transmission of monetary policy actions to financial conditions. And let me stress this important concept. In particular, we need to be careful that international spillovers via higher long-term yields and the exchange rate do not counteract the desired monetary stance. I will come back to it. So this was about criteria number 2 and number 3. Now that inflation has returned to target, we can put more weight on the first criteria, the inflation outlook and forecast. But let me also stress that it raises questions, challenges, because inflation projections rely on various assumptions. So there is this new tools of scenarios. Developing them, applying informed judgment about possible future outcomes can assist policymakers in this uncertain environment. But scenario analysis is no panacea. First, we can only analyze in detail a few scenarios at a time. In practice, 1 or 2, as we did early June with a severe and a mild scenario on trade. And we will inevitably overlook certain shocks that do appear. Second, it might be difficult to assign probabilities to scenarios and therefore to use them for policy risk management, especially in periods such as this one of what we call Knightian uncertainty, Knightian meaning from Frank Knight, as you are all aware, not quantifiable. So, scenarios will be an important aid to decision-making and our decision-making, but they should be used judiciously rather than systematically. What do I mean? Not in all occurrences of ECB forecast and subject to discretion rather than rules in their policy implications. Given all this, let me propose to you 3 principles of monetary agility. First principle, speed of assessment. in rapidly changing circumstances or complex shocks, there is always a temptation to wait for additional data to obtain a fuller picture. But to be agile is to do this analysis faster by exploiting, to give some example, new real-time data sources, by incorporating new models from the staff and the latest research, and by avoiding the excess of group thinking. For example, our analysis of the effects of tariffs have benefited from using daily shipping data and freight prices. Second principle, symmetric and state contingent policy paths. We rightly stress, and this comes from our last monetary policy review in 21, we rightly stress that our monetary action should be as persistent and forceful as needed. But is there a contradiction between persistence in policy and agility? Apparently, yes. But no, if signals are understood to be state contingent and we avoid being boxed in too strict pre-commitments. If the state changes, then so does the policy, including possibly its symmetric direction both ways. Third principle, and I try to be short and we can discuss each of these three principles, about action, acting not stronger, but sometimes faster. And this is about the second qualificative I just used, forceful. What about a forceful response? If required, it is not compulsory to go in incremental steps. Of course, in the presence of new shocks, central banks may prefer a wait-and-see attitude in line with Bernhard's principle of mitigation. I reminded, if the effects of policies are uncertain, it is better to react less. But conversely, a Banque de France research paper entitled "The Pitfall of Cautiousness in Monetary Policy" has shown that waiting for too long can lead to a cautionary bias that undermines inflation expectations. So this might imply shorter and swifter interest rate cycles, although any adjustments still have to be orderly. This brings me to my last consideration: what should we do now? High uncertainty surrounding the global economic outlook obviously calls for humility about our ability to predict future inflation and monetary action. And probably the first virtue of agility is humility. Our primary duty today is to assess risks. I mentioned earlier oil prices, while avoiding to draw automatic monetary conclusions. Overreacting, or conversely, systematically looking through, would be contrary to the necessary monetary agility. We should monitor behind or beyond oil price at least two other sets of data. Do inflation expectations reflect a risk of lasting spillover? And here you have the next slide with the latest market expectations. So far, inflation expectations measured by markets don't reflect a risk of lasting spillover. Medium-term, this is the left-hand panel, medium-term market-based measures of inflation expectations have recently remained clearly below 2% in 26. And if you look at the right-hand panel, this is about the options market, about inflation in 5 years. The probability that inflation falls below 1.5% in 5 years, which is the two blue zones, dark blue and light blue, is, if you added the two figures, around 40%, according to the pricing of options in inflation. As you can see, being beyond or above 2.5, the yellow and red part is much smaller. Second set of data, how is the exchange rate of the euro evolving? Since early 25, and this is the right-hand panel, the euro has appreciated by around 11% against the dollar. This came a bit as a surprise. And this is a sign of increasing relative confidence towards Europe. Obviously, we have no target for the exchange rate. And the last decade since 2015 has seen, you can see it in the left-hand panel, has seen a striking diminution of volatility of the pair. But that does not mean any benign neglect on our side. The recent appreciation of the euro has a clear disinflationary effect. According to our own elasticities, its magnitude for a 10% appreciation of the euro would broadly compensate the inflationary effect of a possible 10 euro increase of the oil price. And we are still quite far from this 10 euro increase as of today. Let me sum up. From today's perspective, the risk of undershooting our 2% inflation target is perceived by markets as greater than that of overshooting. In our June projections, which you can see here, headline inflation is indeed seen to fall below 2% in the second quarter of this year and to continue to decline into early 26 with a trough of around 1.4%. This decline would be driven by all the main components, not only energy, but also core inflation, resulting from low wage growth and weak demand. The projection increase to 2.0% in 27 is amplified by a temporary upward impact from energy inflation, reflecting a technical factor not very well known, which is the introduction of the new emissions trading system called ETS2 in Europe. This measure is desirable to fight climate change, but far from certain, both in its timing and modalities. So, in such a context, we need to remain alert and agile in all our next meetings. Can I quote the famous French philosopher Voltaire? And I will quote him in French for a while. Le doute n'est pas un état bien agréable, mais l'assurance est un état ridicule. In modern English, doubt is not a very pleasant state, but certainty is a ridiculous one. We are not at risk of being ridiculous, if I may. With this due Voltairean wisdom, let me only give, with much caution, two possible landmarks. A neutral rate and a terminal rate are two different animals. They can happen to be in the same position, but they are not identical by nature. And B, the current assessment suggests that and this is the important cautionary word, that barring a major exogenous shock, including possible new military developments in the Middle East, if, I stress the if monetary policy were to move in the next 6 months, it could be more in the direction of accommodation. I quoted Voltaire. Let me conclude with a great Florentine writer, Niccolo Machiavelli. You know that according to him, two forces shape the course of events: fortuna and virtue. They are still available today. Fortuna, or fate, stands for the unpredictable shocks that affect us. And there are many: geopolitical tension, technological disruption, and other external forces beyond our control. Virtue, or courage, by contrast, reflects our ability to act with determination, to adapt, and to anticipate. In this context of heightened uncertainty, the tension between stability and volatility puts our monetary policy stance to the test. But through virtue, our capacity for clear-sighted and agile action, we can secure lasting success. Monetary policy can, along the three principles I suggested, remain not only agile, but also predictable and, as I said, readable. Striking this balance, we will ensure that with the highest ever confidence in the euro, at 83% of our fellow European citizens, our shared currency, our common treasure, remains ready to navigate an uncertain future. Thank you very much.
Thank you very much, François. That was great. So maybe open the floor for comments, questions.
I have many, so let me start with a couple and then leave open to other people. So two questions. Clearly, agility means that in a way the ECB or central banks feel now more comfortable with the model they use to detect shocks, to trace the implication of these shocks, so that they can, with more confidence, saying this is our reaction function. Now, this confidence was a little bit shaken during the big inflation hike, no? After for many reasons. So I just wonder, I'm saying this because we are on the receiving side of the equation, which is we are the modelers. So, and we have been doing lots of models. We introduced, for example, sectoral shocks, which were absent in most of our thinking. There is now more heterogeneity. So should we take your welcoming of the more agile period in the sense that we are more confident on the models that we use? One question. The second question is related to this. There is a sense in which underlying inflation and wages are catching up from the big hike. And one could expect that there will be a physiological adjustment in wages. No, we cannot ask workers to take a 10%, 20% cut in real terms. So is there also part of the equation, the fact that not to panic, or the famous wage price spiral, to distinguish between what is physiological on the price level and what could create adverse dynamics? I just see that there is a little bit of link between these two elements.
No, grazie per le domande. Can I start with the second question, because I think it's easier to answer. First, about this question of wage catch-up, it's different from a country to another, because it depends on the kind of wage agreements and wage negotiations they are. Let me take two opposite situations. In my country, France, It's a yearly negotiation and very decentralized. So there was no question of catching up, so to say, because each year the inflation could be incorporated. If I take Germany on the other side, most agreements are on a 3-year basis. And this question of catching up played a role in the significant increase of German wages. Let me take the example of last year. But what we see as present is that everywhere in France, but also in Germany and in northern countries, we see a moderation of wage increase. So this catching up effect played a role. We don't expect, and I mentioned moderate wage growth as a factor of moderate inflation in the years to come. We don't expect, all things being equal, and I always repeat, bearing a major exogenous shock, we don't expect surprises on the wage front. And we are reassured or comforted by what we have seen in the evolution of wages this year. And we also use a wage tracker, which gives the same indications everywhere. This brings me to the first question. Rather than confidence in our models, we use our models, I would speak of increased confidence in our forecast, at least. And this is what I said about the 3 criteria or the 3 parts of our reaction function. Why do we give more importance to the first criteria, inflation outlook? Because we are over with this phase of inflation surge. And if you look at our inflation forecast for all the last quarters, they didn't change much. And so they have been more and more reliable. By the way, can I add one thing, which I didn't stress in my speech, that we think that for the euro area, tariffs, wherever they are, will have a negative effect on growth, for sure. We can discuss it. This was not my theme today, but they will have a limited effect on inflation. And this is an important point. This is different from the US. And why is it different? There are many reasons, but to give one obvious one, tariffs in the US apply to all imports coming from all countries. If we have some tariffs in Europe, I don't know whether retaliation will happen or not, this is not my thing. But if we have some tariffs on Europe, it should be focused on US imports. And there are other reasons to have limited effect in all our scenarios of tariffs on inflation, against bearing other major shocks. So increased confidence in our forecast, that does not mean complacency. And this is why I insisted on scenarios. Many things could happen, and we have to open our judgment. Scenarios can help us, but nothing at the end of the day, nothing will replace judgment. This is why I spoke of discretion rather than rules. Models can help, and we have various models. We use elasticity. I mentioned also one result of elasticity for the exchange rate and for the oil price on inflation. But at the end, we should not obey blindly to models. And here they are very useful, but they are not our masters, if I may.
Thank you very much. Tobias, please.
Thank you very much for this. My question, so there was a broader question about arguably one of the things that underlies many of the things you touched upon, right? And that's the role and importance of the dollar. So, clearly there's many things are going on, right? And even you talked about monetary sovereignty, but, as you know, I don't know, 30% of European external trade is invoiced in dollars. Most of our debt instruments in the Eurozone, or a substantial portion of them, are in dollars. So what do you see as both some of the opportunities that the Eurozone will have as a decline maybe of dollar dominance? And also what do you see as some of the dangers?
First, when we speak of monetary sovereignty, is to state the obvious. Our monetary policy is independent. It's independent from governments, it's independent from private interests, but it's also independent, and Christine Lagarde stressed it many times, of the US monetary policy. And it's a good thing. We have domestic objectives, which is price stability. I will not comment Chair Powell's decision yesterday evening and press conference, but he looks at the US inflation and we look at the European situation. I state the obvious, but it's worth perhaps to spend 1 minute on that. Because remember the debate 1 year ago about decoupling. We were at that time already a bit lower in our interest rate with 4% and the Fed at more than 5%. But there was this question, can the ECB decouple? I don't like this word, of the Fed. The answer has been yes, obviously. And we have cut rates earlier, June instead of September. We have cut rates quicker, and we have cut rates much lower. This is not very often stressed, but we are at 2%, while the Fed and the Bank of England, by change we will see today, and don't want to preclude, are at 4.25%. So this is really monetary sovereignty. Or to put the counterfactual, you are too young, but Marco and myself, you alluded to the 90s, before the euro. When there was shock on the dollar or on the US monetary policy, it had direct monetary consequences in Europe. And some currencies appreciated, others were undervalued. They had to react in their own monetary policy. So this monetary independence has a strong value added for Europe. Then you raise another question, which is not directly about monetary sovereignty, which is the international role of the dollar versus the euro or other currencies. Here, I will be more cautious because the dollar is the center of the system. You quoted figure for invoices, we could take exchange rate reserves, etc. There could be a wish by international investors to diversify their assets. We'll see. We have seen some signs of this trend, but it's a very gradual move. The central role of the dollar will remain. Christine Lagarde gave a very important speech 2 weeks ago, and I see you could read it in Berlin. She published an op-ed in the FT this week about what she calls a global euro. And this is very important. Let me really stress the significance of this speech. 2 considerations of that. First, I will perhaps surprise you, but in the treaty we negotiated together, Caro Marco, the international role of the euro is not inscripted. It's not part of the. Apparently, you don't agree, Marco. No, it's not part of the official objectives of the ECB. We have price stability as a primary mandate. We have several secondary mandates, but no mention of the international role of the euro. It does not mean that we don't care, that we couldn't care, that we couldn't try to develop it, but it explains why in the 2 first decades of the euro, it was not a first objective. And second, in order to facilitate investors' wish, and it will be private investors' decision, it is not up to us to decide, I am impressed by the convergence between what I call the internal and the external objective. What do I mean? The internal objective is a saving and investment union. We need, I insisted on it in my right column at the start, we need to develop the single market, Draghi and Letta, and the saving and investment union, what we could call financial sovereignty. And we need to develop it for an internal reason. It's to better fund our investment and innovation needs. Think of artificial intelligence, think of clean energy. We have huge investment needs. We have huge private savings, but we don't channel the huge private savings to the huge investment needs, or not efficiently enough. And the external objective is to have more international investors. And one clear condition for that is to have a deeper, a broader, a more integrated financial market in the euro area, saving and investment union. Among these elements, one very important question is probably the question of a safe asset. And there are various ways of achieving it, more EU issued debt, be it Commission, ESM, etc. Mutualization of a part of existing national debt. There was a recent proposal by Blanchard and Oubidé, but there are many others with blue and red debt. If there are further questions, we can enter into more details. Can I only stress that none of this solution is totally simple, be it from a technical or political standpoint. But probably it belongs to savings and investment union. It's not the only point. I think saving and investment union is very important about equity, venture capital, which is another thing. It's very important about centralized supervision. So there are other elements. But again, convergence between the internal and external objective. I'll stop there.
Okay, let me say just one consideration, then Marcello will take the floor. Prompt a bit from what you said, François. Okay, first of all, you had okay, now we don't have the slides anymore, but you had an extraordinary one, which I don't know if Adrian, can we put back the slides? Because you had the second one, back to 2 and 2. Which is okay. If this is difficult, we don't no problem. Okay, the second one, no, this one here. Okay, because Goldilocks, no, in the present situation, you have basically you are on target on inflation. You are no problem in terms of inflation expectations, as in demonstrated by the forecast of the ECB, and you are at R star in nominal terms, with coherent with.
So we are in a good position.
You are in a very good position.
If I can quote again my president, Christine Lagarde.
You do not. I mean, if you would put here superimposed a measure to this thing, or of let's say financial stability, you would also have a very a very benign view. I say this because I mean we have worked with Marcello, who is going to take the floor in a moment, on comparing what has happened this time after Moody's downgrading of the US Treasuries, and what S&P did in August 2010. So what happened at the time was the crisis, the increased uncertainty created or accentuated by the downgrading for the first time of US Treasuries, crossed the Atlantic immediately, and actually it had the paradoxical effect of increased uncertainty, more flow into the US market, even though that was the source of the increased uncertainty, and we were indeed the victim of that at the time, with the measures of financial stability going through the roof. So my first question is, how resilient are we now? Can we be? I mean, can we be in the light of the two and two? be reasonably confident that at the end of the day we are in a much better position than we were basically 15 years ago, or can we still should we still worry? So this is my first question. The second question is on the safe asset that you mentioned. I mean, we have here the debate puts the emphasis on two concepts of looking at safe asset, or at least two ways to look at it. Okay, one is you mentioned Blanchard will be is the last of many papers on this front. So what they do, they look at the stock. So they say we have to create a large amount of safe asset in Europe. So swap national debt for EU debt. So this looks at the stock. Typically, and I have seen the decision making in the European Union from the inside, typically the political conditions point to flows. What does it mean? It means that you have a priority. Eventually, after a lot of resistance, there is willingness to move there. And for a particular priority, which was Next Generation EU back in COVID, possibly now defense, you create the conditions to say, okay, let's finance it together. It's a European public good. Well, let's put it. And here it is the flow because you only finance the delta. So the political conditions point to the second. The actual need would point to the first, especially if you want to boost the international role of the euro and profit from. So how do you solve this conundrum?
These are two good questions, Marco. About the first one, are there spillovers from the US situation to the European market on bonds? Again, we should be extremely modest about any forecast. But what we have seen so far, you are right, is that this time is different. And that the evolution of long-term yield on both sides of the Atlantic has been, it's a rather modest difference, but if you look at the direction, long-term yields diminished as a whole in Europe. There was much volatility. Remember the German announcement, it increased significantly long-term yields and then it went down, etc. And on the other side of the Atlantic, long-term yields increased. There was even early April on the bonds market, a very significant volatility. Remember April the 7th and the 8th, and these dates are important because it's just before April the 9th. And clearly there was at that time an alert on the bond market. What we see now is that probably investors everywhere are more sensitive, more vigilant on fiscal policies. It's true in the US, but I wouldn't conclude that it does not exist elsewhere. It exists less. This is a nuance I would introduce. So probably no automatic spillover, and this is part of European autonomy. But I wouldn't conclude that we shouldn't be vigilant on fiscal policies everywhere. On your second question about safe assets, you are right, there are different means of achieving the goal. And none of them is obvious. Let me stress it. If I prolong what you said, there is a common debt issue and there is a mutualized debt issue. Common debt is issuing more EU. So you mentioned in GEU, defense is a possible avenue, but if there is common debt on defense, there must be a common industrial supply on defense. It has a meaning only if it encourages further industrial cooperation cross-border. And we know it's not obvious, to say the least. But it could make sense, and there is a political opportunity. If I remain on this first avenue of common debt, I could mention also the ESM, because the European Stability Mechanism, or even for them EIB, but it's a somewhat different family. The European Stability Mechanism has also a quite significant amount of debt. But technically, it's not obvious, and probably defense is an interesting political debate. I don't exclude it. Can I only stress, seen from my country, perhaps also from this country, Italy, that issuing more common debt cannot mean transferring our fiscal challenge to the EU. And we know how other countries, Germany, but many others, are sensitive to this idea. We have to be vigilant on our own national fiscal policy anyway. And issuing more EU common debt is to address common challenges. It's not to solve the national debt coming from the past. This is obvious, but it should be stressed. And then there is a second avenue, Blanchard, Obidet, and you are right, many others, which is what I would call mutualized debt. And then I am ready to have the technical debate. Is it about the existing amount? Is it about the future flows? Future flows would probably be technically and politically easier, but it's not the same amount, etc. This is why I said there is no obvious technical and political solution. We should acknowledge it. There is no obvious solution. But what we can wish is to say we now have this issue on the table as part of the Saving and Investment Union agenda. It will probably come later. When I mentioned the 1st of January 28, I think this would be too ambitious for this part of the agenda, because it's more difficult. We will have the question of defense. It's perhaps an opportunity to make progress, but let us at least acknowledge that the issue could be part of the discussion, although it's not obvious.
Thank you very much. Marcello, maybe you can...
But by the way, if I may add one thing, Marco, in the Draghi report, which is really very rich, if you remember, when it was published, all the attention was focused on this question of Eurobonds. And Mario himself said that there are many... here we are back. Mario himself said that there are many other things in his report about structural reforms, structural issues. And when I speak of implementing the Draghi and Letta report, if possible by the 1st of January 28, I think much more to the structural part. Eurobonds are not a prerequisite to implement the Draghi report.
Many thanks for your presentation, and I have to confess that my two questions were covered by the last discussion that you had. Let me just go back to the first question raised by Marco by adding a different dimension, starting from the current monetary policy, and obviously to implement your very stimulating concept of monetary policy agility, we need to know where we are currently. And if I well understood, you maintain that the current stance of monetary policy is more or less neutral. And I would fully agree with your statement if we have a facility rate of 2%, an inflation around 2%, maintaining that the current stance of monetary policy is neutral means that we have in mind a so-called natural interest rate around zero. And I would like to check if you agree on this statement. And let me add just a very short remark on the second question. I fully agree that we currently have this debate between flows and stocks. According to the history of economic analysis, this is a very old question. Hicks maintained that it's not possible to separate flows and stocks. Hence, I agree with you. Maybe from an economic policy point of view, it's a good move to refer to flows in the short term and to stocks in the long terms, due to the fact that the accumulation of flows imply in the long term a given amount of stocks. So this possibly is the solution of these 22 catch. Thank you.
Perhaps on your second question, I will be very brief, because I don't pretend today to have the solution of this question of the safe asset. I only stress that it could be part of the agenda. This question is coming back without urgency, but this question is coming back. But let us be honest, there is no obvious solution, be it from a technical or from a political standpoint, and the answer does not belong to us, ECB, or not only to us, to say the least. On your first question about the neutral rate, and this is a very good question, two considerations. First, we know about the beauty of R star. It's a very useful economic concept, but nobody can observe R star. I have never seen R star. You have never seen R star. I happen to be a Christian, if you allow me a private remark, but sometimes it's a bit like religious belief. There are things you can believe in without seeing them. So this was with a smile. There are estimates of R star. Trying to answer your questions, and our ECB estimates are more or less what you said. We have a range, and we have a range in real terms of around zero, something like minus 0.25 or minus 0.5 plus 0.25. And there are official ECB publications. The last ECB bulletin, if I'm right, was published in February on this issue. So if you add the 2%, it's around 2% in nominal terms. But it's a range. My second consideration is that R star was very useful when we were far away. And if I take a very simple physical image, when there is a star in the sky and the star is quite far away, you walk to the star. When you are in the zone of the star, it's much less useful to guide you. And so this is what I said in my speech. And this is what we say in our monetary policy statement. If I can draw your attention on one point, we had expressions in our past monetary policy statements about the idea of being restrictive, the degree of restrictiveness. We still had a restrictive stance. We were less and less restrictive. There were various expressions. But this mention of restrictiveness disappeared in our latest MPS. And it's not by chance, because now the question is not or is less about the question, are we restrictive, should we be, are we neutral, are we accommodative, is are we adapted to the present circumstances. So again, we think we are in a good position, but as I said, it's back to normal. It does not mean that we cannot change in the future.
Thank you very much. Odysseus.
Thank you so much for your presentation. Very interesting. I want to take you back to something that you mentioned that kind of puzzled me, and maybe you can elaborate a bit on that. You said that we have no target for the exchange rate, but currently we are in this very fortunate conjuncture in which the euro is appreciating, and this has disinflationary effects. And I'm wondering whether we should have a target for the exchange rate. And I am aware of the fact that it's not part of the mandate of the ECB to have a specific exchange rate vis-a-vis other currencies. But, and here I'm tweaking a bit the secondary mandate of the central bank, which is to support the general economic policies of the Union. Shouldn't we pursue an exchange rate strategy over the medium and long term, especially now when we are trying to transform the European growth model? Because in a world in which our exports are no longer as competitive in the world markets, what kind of exchange rate do we want? Thank you.
Thank you also for this question. When I said we have no target for the exchange rate, I hope it was nothing new. It was not a surprise to you. We repeat it, and we will still repeat it in the future. I will explain why. Can I add that it's nothing specific? It's the same for all large economies and major central banks, same for the Fed, same for the Bank of England. And we have a domestic target, which is price stability. There are legal reasons for us. Our primary mandate is predominant, but there are also very good economic reasons. It's not by chance that each major central banks came to the predominance of this domestic price stability target, and by the way, around 2% for each major central bank. This is what Jean-Claude Trichet, one of my predecessors in the Banque de France and former president of the ECB, calls the great intellectual convergence. It has perhaps not been stressed enough, but this idea that all major central banks are now inflation targeters, I think, is a decisive step, and it served us very well. It served us well to achieve price stability, but it was not with a cost of extreme exchange rate volatility. I could even say on the contrary, referring to what we have seen since 2015. I don't say it's a causality, but at least it's a coincidence. Should we change in the future? I don't think so. So we agree to disagree, if I may. First, it would be a legal twist, really looking at the secondary targets and concluding that an exchange rate target would be important. And second, it can be adapted for other economies. As a rule, smaller economies, very open one. And here the exchange rate is of utmost importance. But in our case, I don't think it would be adequate for the first economy of the world, more or less at the same level than the US economy. It does not mean that it's a benign neglect. I insisted on it in my speech. We have to take into account the inflationary/disinflationary effect of the exchange rate in our own economic forecast and our own monetary policy decisions. But sorry to stick to our existing mandate. I think it's also adapted for the future. I hope I didn't misunderstand your question.
So you do not adhere to the Mar-a-Lago doctrine of calling for a new plaza agreement?
No, if I dared, Marco, I would say that I don't know who supports this doctrine. No, it was an important paper by Stefan Miran as an academic, but I'm not sure, to say the least, that it's the official position of the US administration. What we hear from them is that it remains an academic paper.
You can abuse my time. And I have two questions seemingly unrelated. So the first question is coming back to the exchange rate. How do you see the communication of the ECB in the future? For example, clearly R star, when it was far, was a good communications element. Today becomes problematic to build communication R star. How about scenarios? I personally have severe issues about the usefulness of scenarios as communication. And in these scenarios are usually, in the Fed, they are not communicated. How do you see this way of convincing markets about this new agile? And then, if I may be provocative, going back to the safe asset, there is always a question of whether the safe asset could be part of the construction of the safe investment union, enlarging the issue from defense to security, hence introducing innovation, and thinking of something like the government-sponsored enterprises in the US. So you have basically some enterprises, some balance sheet, effectively, that sort of may be complementary to markets, mutual funds or venture capitalists, into mediating saving and investment. And part of the balance sheet would produce something that could be very close to a safe asset. No, it could be kind of producing part of the financing as a safe asset that is clearly related to defense. Now, why is important the ECB here, or something like the ECB? Because for these markets to work, there must be some value at risk. I know that many political parties do not like the idea of doing leverage, but there also be a little bit of a stake of the monetary institutions in Europe to stabilize this market, to avoid self-fulfilling market driven runs on this instrument. So communicating this will be a challenge, but in a way it is in the same general chapter of whatever it takes, in this case, to build a stronger Europe in terms of innovation, defense, and everything, with instruments that are complementary to market, may even be designed to fade in the long run, right? We start with those and then we become less important, but in principle could be part of the strategy.
On your first question about ECB communication, it should be modest. I think it's the first virtue, to quote Machiavelli. And if you look at our usual wording in all our last meetings, we say data-driven and meeting by meeting. This is the most pragmatic, probably words we can use. I sometimes speak of agile pragmatism because data-driven, and agile because of agility I mentioned today and I elaborated upon. I think the markets are assessing quite well this communication. I tried to give today some lights about the reaction function and what agility means. But I don't think at all that the only avenue for our communication is to give clear-cut and committing forward guidance for the future. To quote Voltaire again, it would be inadequate in the uncertain world we live in. So it's a pragmatic and modest communication. It does not mean that there is no predictability, that it's not understandable, and I think it works quite well at present. But everybody should accept that facing a more volatile environment, we have a more agile monetary policy. And I tried to show today that agile does not mean blind. On your second question, listening to you, I thought I agreed, and at the end I'm less sure I agree. Let me elaborate. No, I agree on one thing, but this is probably not your core message. That saving and investment union is not only about the safe asset. Let me stress that. And the question of equity, balance sheet, venture capital is of the assets. So I go a bit further. No, but this one is important. I take the opportunity. we lag behind in innovation in many fields. It's true for AI, it's true for electric vehicle, it's true for energy, it's true for part of defense, etc. One of the explanations, I don't say it's the only one, but one of the explanations is financial. You are perhaps less aware that we lag behind in equity and venture capital in very significant proportions. Let me give two figures. If you look at corporate equity to GDP, it's in Europe more or less 90%. No significant differences between France, Italy, and others. 90%. In the US, it's 220%, more than double. If I look at venture capital, the gap is still more increasing. The funds raised by US venture capitalists in the last decade have been 5 times higher compared to European funds as a proportion of GDP. And this plays a role. If you are a firm, you are financed through debt, you are less inclined to take risks. And if you are an investor and you put your money in debt, be it through banks or through private credit, you are less inclined to accept risk. Because if there is a failure, you will lose. But if there is a success, you will not have the upside. So this is a key thing we have to change. And it has nothing to do with safe asset. Here we agree. Where perhaps I missed your point is this idea of, you didn't say it this way, a shadow safe asset, including defense, etc. And I'm not sure we have such a thing. But perhaps I missed your point. I'm even not sure it exists in the US. You could consider perhaps that you have a broader market with the defense industry, with some public involvement, be it implicit, etc. But if you look at the US market, the treasury market is already very significant. So fair enough if you had defense. But I think it's difficult to imagine that in Europe we have such a proxy. It would remain domestic in each case. So you have an Italian, a German, a French defense industry. There could be a link with the domestic treasury market in each case, but this does not mean a deep enough market, if I got your point rightly.
We are coming to the end of this. So time for a very last before maybe Giancarlo says one sentence at the end. Anything? Okay, Anton, please.
Yeah. I wasn't here for the talk, but I'm trying to sort of enter the conversation a little bit. I think what you just said is very interesting, that the reason we lag behind in innovation has to do with finance. Now, not so long ago, it was said that the reason we lag behind in innovation has to do with the welfare state. The welfare state, we spend, European countries spend about 30% of GDP on many things, including pensions. If you do a comparative analysis of how this money is spent, and using the metaphors of stock flows and buffers, it's very interesting that Scandinavian countries and also the Netherlands spend quite a bit on human capital stock. They have generous and very adequate pensions. They help families ease the course over the life course, so making dual earner families more agile, resilient, less child poverty, etc., etc. And that kind of, and you probably also see in these countries where financial markets are more agile, if you want to use that word. So in a way, given the fact that we spend so much on welfare provision, and I would include health and education, this is a positive asset, but it is a positive asset only in a particular kind of policy mix. And I know, monetary policy tries to target wage policy and inflation, but, given the fact that we're aging population, this is going to be very important. So the countries that are, let's say, more pension biased and less what I would like to call social investment biased will create problems for the Eurozone because, it reinforces divergence. And coming back to your earlier point, if this is the case, then, having Italy solve its own fiscal problem will probably reinforce that internal divergence because of aging and not investing in education. So in this sense, there's a case to be made to, rather than, put all our eggs in defense spending, to make welfare states of the French in particular, I would say, and the Italian kind, less so Spain, more agile. Could you reflect on this for a second?
Okay, before you answer, Francois, okay, I want to reveal a secret.
It's a very simple question.
No, it's very simple. I want to reveal a secret that you are not going to say that I'm, because I think I know. I think one thing that, beside monetary policy, Francois is passionate about is the quality of public spending. Am I right? So
Yes.
This, in a sense, is somehow connected to this question. Please.
So I will try to be brief because it's a very important question. First, I said that this question of funding for equity is one of the reasons for our innovation lag, and there are several. And I will come back to it because there is always a temptation to say, when you put forward one element, people say, no, it's not this one which is decisive, it's another one. If we wait to have solved all the issues, we will never make progress. So funding is one part of the solution. I have always been personally cautious about criticizing the social model as the key explanation. Also for one very pragmatic reason, when I look in Europe, the most innovative countries are the northern ones, which have a developed social model. Which brings me to two considerations. I don't want to say that we don't have to gain efficiency in social expenditures. And here comes our common passion, caro Marco. If I can give a call here, we need more economic research, more help from your side on the efficiency of public expenditures. I still said it, I was yesterday in Milano con Giovanni, and I still said that on fiscal policies, I would like sometime all the macro debate to be complemented by a more micro research. How can we make progress in the efficiency? Using, for example, benchmarks. We are lucky enough to have 27 EU countries with more or less the same public model. And we know that some countries are much more efficient. So let us look at it. And obviously, in some countries, including mine, we can make progress. The second link is about how do we finance pensions? And here it's the question, do we have what we call in our French wording repartition, so pay as you go, or do we have capitalization, which we have in Northern Europe? And obviously such capitalization scheme, pension funds, help to have patient savings. It's not completely by chance that the country in Europe which has the most developed venture capital fund, EQT, is Sweden, and it has a very developed pension fund system. But again, it's not a prerequisite. I asked a question to my Swedish colleague. I said, do we need to develop patient saving in France? Do we need more, or do we need to develop a pension fund scheme, which raised many political questions? His answer was no. It will make things easier, but it's not a prerequisite. It would help, so probably. Last consideration, when I said it's not the only element, we have probably an issue, we have an issue on regulation, clearly. There are much critics against European bureaucracy, red tape, etc. These critics are a bit exaggerated, but they are not completely wrong. Let us be honest. So in order to innovate faster, we need at least more consistent and predictable regulation, and we have room for improvement. But I think there is one element which is more cultural, which is our ability, our collective desire as Europeans to take more risks. And here it's more difficult to change. But there is perhaps one element which we can change, which is this question of the cost of failure. If you are an entrepreneur and you fail, what cost do you have to pay? It's a direct, immediate cost. And they have been worked by Olivier Coste and other researchers. They say that the cost of failure is 10 times higher in France or Italy than in the US or in Denmark. This 10 times is probably exaggerated, but the direct cost is higher. And what I would call the indirect cost, about your reputation, about your ability to have new projects in the future. Here, this is a question of insolvency law, registers, etc. We should think about it. But again, this is my strong message about all the Draghi report, Letta report, Saving and Investment Union. Let us make progress in each field. And let us not always say, when a proposal is on the table, this one on equity and venture capital, this is not at all what you said, and I am grateful for that, but I look at the political debate. Each time there is one proposal off the table, you have 3 hands raised saying, I don't accept your proposal because this is not the main root of our innovation problem. If it's that, we will completely forget about this nice, I don't know if it's an Italian saying, Marco, I will check. La differenza tra un sogno e un progetto è una data di scadenza. Let us act now and faster, really faster. We have a possible European momentum, but it's this year. If we don't seize it this year, I am at least, or I will be at least disappointed. This is not about monetary policy, but I think it's a good message also for the European Institute of Florence. Grazie di nuovo.
Let me close thanking Governor Villeroy for this fantastic speech. I cannot but quote that I remember when I was a student, long lectures on the welfare state as an instrument of competitiveness rather than a burden. And I think this is the way to talk about it. And relatedly, I don't think Europeans are different from the US in their relation with risk. They're different in the structure of the financial market and the structure of the legislation that makes certain risks impossible to take or very costly to take. So this is a reflection. Let me conclude with 2 remarks. The first remark is that the EUI and the Banque de France have a long tradition of strict intellectual exchanges. We have a yearly conference on international economics. We have now webinars with the Sestrieri and other sector of the. Last week I was there with Agnes. We had an afternoon on the trade policy. So it is. We hope to keep the relation as productive and as frequent as it has been in the last few years, and it will be inclusive. There are many issues raised that it would be important to share with students and postdocs and other faculty. The last thing, I learned a lot of important quotes today, the Voltaire. I would like one is not a quote. As a student, a friend of Bill Brainerd never said that when there is uncertainty, we need to do less. Actually, if you read the paper, it depends on the structure of the uncertainty. Sometimes you want to do less, sometimes you want to do more. This is something maybe I should write a note because it is often misquoted as a reason not to act. It really depends on the way uncertainty enters the model. And the last bit, I didn't know that Machiavelli had such a strong link with Yogi Berra, the baseball champion in the US, who once said that in baseball, 90% is mental, the remaining 50% is physical. So in an agile monetary policy, I guess 90% will be to be prepared, and then 50% luck would be, the fortune would be a good assistance. So I would say, thank you for participating.
If you allow me, our wish is also to continue the cooperation. And about this mix between courage and luck, there's also a famous quote by Napoleon. But as I am in Italy, it's probably the only place in Europe outside of France where I dare quoting Napoleon. He said in his case 2/3 and 1/3. But there is no scientific probably law about we need both. And we will have courage.